When you begin a new database in CenterPoint, you'll need to establish beginning balances that describe the financial picture of your operation prior to entering first transactions in CenterPoint. We're going to be going through the different ways to enter beginning balances for all of your different accounts. We'll start with Setup, Accounts, and we're going to go to the Balances tab. If you have multiple companies in your database, you'll be working with one company at a time. Each company stores its own balances. So you'll select your company in the upper left. In the upper right, click Beginning Period. That takes you to the beginning period of this database, which is the period prior to your month of first transactions. Down at the bottom of the screen is an Options button. CenterPoint stores values for book values, modified cash, and market values. We'll be working with book values, and as we add those book values and save them, it will automatically update your market values. And after those market values are updated with the same value, you can make any changes as needed for accounts such as your depreciable items that might have a different market value. If you're using modified cash values, there's another video on establishing beginning cash values. Now we're going to expand our balance sheet account types here on our list, and we're going to right click and go to expand all groups. That expands each account category and the accounts underneath it. And you're going to want to be referring to a previous balance sheet that you had. And if you click in the book value column on the account row, that will allow you to enter a value in that row. So we can enter whatever that value is on our balance sheet and go right down the row and enter any values that we have existing as of this beginning period. Accounts receivable won't be entered through this screen. We'll be entering those beginning balances through a customer invoice because the balances are stored for individual customers. So to maintain that, we'll enter those through a transaction. We'll do that in a little bit. Several of the inventories can be entered through beginning balances, but if you have any purchased inventory that you're reselling, that'll be done through a journal entry to also maintain purchases and cost per unit per purchase of those different entries that you'll be selling later. But on your inventories that are for your raw materials that you'll be using for producing crops or livestock, or work in process accounts, or raised inventory, any of those can be put in through beginning balances. So we have one here for seed plant raw material that we have beginning balances for. If you highlight the account, this particular account's being maintained by another balance detail of product. And we wouldn't be able to enter the value right in the book value column here, but we have a detail balances button. If you click the Detail Balances button, a grid displays where we can put in the detail that we need and put in our beginning balance. So we have a beginning balance for one of our corn seeds, and then we can put in what value we want there. And we'll put in 9,000, and we'll put in a quantity of 45. And then we'll have another product. You can just keep going right on down the list to identify each one of those that you have for a beginning balance. And we'll put in a quantity of 22 here. And when you're done, you're going to click Save, and then that will update that particular row, and you can expand that row and see the details that you entered. And then you would go and update any other rows that have that particular need of having a beginning balance by going to Detail Balance. Raised crop inventory might be another one that you need detail if you're storing that inventory by, in this case, production year and location. I can put in my production year that inventory represented and where it's being stored, and then put in a book value for that particular crop and a quantity, and then save. And that updates the balance. As we go down the list, there are any work in process. You could update those balances as needed. And we're going to go on down to liabilities. Accounts payable, if you have beginning balances for accounts payable or credit cards, Those again won't be entered though through this screen. They would be entered through a vendor invoice, and we'll do that also in a little bit. But if you have other liabilities like equipment loans or long-term loans, those would be entered in this screen. So we could come to our 15 combine loan and put in the balance that is outstanding at this point and any other balances that might be out there. And once you're done, you're going to be able to click Save. You won't be putting in any beginning balances to retained earnings. Retained earnings is going to be updated automatically by entering the other values that you're entering. That's what's making a balanced transaction for this journal entry. But if you have other equity accounts like the capital accounts or contributed capital that need a balance, you can enter the balances as needed in these accounts also. Once you're done, you're going to click Save. It's going to tell you how many accounts that it's updating. And when it's done, you'll see that it will have updated the market value also. And now we can next go and do any fixed assets. So we did not also enter any beginning balances for any of our depreciable items here, like machinery and equipment or buildings. Those have fixed asset items under it, and instead of entering the balances through the account, you'll want to enter it through the fixed asset item. So to do that, we're going to go to Setup, Fixed Assets, and Fixed Assets again. And it's done the same way. You're going to go to the Balances tab, select your company, select Beginning Period, and Expand All so that you can see all the individual items. And again, we have our Options button that's defaulting to Book Value. And we can click and start entering our beginning balances for each one of our fixed assets down the line. And wherever we have a book value that is existing on that particular asset, we're going to put in the value. And when we're done entering all of those individual book values, we can save it. That will update it. And now if we needed to change the market values to update that to be different than the book, we can switch to market, and then we'd be able to update this market value also. So we could change this market value if we needed to. And when you're done, just save again. And that establishes your beginning fixed asset balances. Now we're going to put in our beginning balances for any outstanding payables. So we're going to go to Vendor Invoice, select the vendor that we have a payable with, and we have an RW Repairs. It'll default to your account payable account, and then put in the date of your beginning balance date again. Oops. There we go. I didn't enter that right apparently. And then you're going to put in the amount for this particular vendor, and then select the account that that's for. You can either select the account that it was actually for, or if you don't want to worry about what that account was, because it's in your beginning period, you're not going to be analyzing data in CenterPoint for this data that's in your beginning period. That will begin as of the date of your first transactions. However, if you're doing a cash report, like a cash income statement, which reports back to the account that that payable was for when it was paid, then you would want the account that it really represents. So we've used this repair expense for the $500. It does have a distribution on it, that's fine. And we're going to go ahead and save that transaction, and that will be part of our beginning balances. If you were doing a credit card, then you would just change the AP account to one of your credit cards, and then select the vendor that you'd want to represent in that particular credit card account, and same way, use the account you want it to represent and the amount. Now we're going to put in a beginning balance for a customer invoice. So we'll go up to Processes, Sales, Customer Invoice, and we'll choose our elevator. Again, our beginning period. And the account can be, again, either retained earnings or the account that it really represented. And we'll put in the amount. And we're ready to save that. We don't need to print here. And we'll save that transaction. That established our beginning balance for that customer, and if we had others, you can just keep going and go to the next customer. Now, if we had beginning balance for any purchased inventory for resale, those will be done under Processes General Journals. So we can put a name here. We don't have to for beginning balances. Change our date again to our beginning balance date and pick our purchased inventory, which we have a purchased feeder cattle, and put in the quantity that we have on hand as of that point. And we can put in the value, which will be a debit. This is an asset, so we're going to put it in as a debit. And we need a detail because we're storing our purchased inventory by production center detail. So we'll go out and find our production center detail, which is this South Barn Feeders. And you can keep going on any other purchased inventory. You'd want to do a journal row for every purchase cost per unit. So if you purchased into the same inventory but at different costs per unit, cost per head in this case, then each different purchase would be a separate row so that it updates that particular inventory with the right cost per units for it, selling it later. Once you're done entering all of the different pieces that you need there, the last item is going to be retained earnings to make this balanced. Click your difference button. That'll update the retained earnings amount. You can put in a notation of beginning balance if you want, and then you're ready to save. And the last thing is, if you are starting CenterPoint mid-year and you want to establish beginning year-to-date values for each one of your income statement accounts, that will again be done in this general journal screen. So again, you would keep it at the 12/31/18, in this case, your beginning period, and then you'll want to print out a current year-to-date income statement and use those figures on that income statement to fill out this grid. So you would start with your first income account that is on the income statement, and then put in what that value is. So if it is a revenue account and a positive value, you'll put it in as a credit. So we'll put in a figure. And you can identify profit center if you want to. And you would just keep on going with all of your different revenue accounts. When you're done with the revenue accounts, then you can begin with your cost of good accounts off of that income statement and put in the values for that, whatever it is. And when you're done with the cost accounts, then you can go to your expense accounts like electricity and put in that value. Again, expenses will be a debit, and you'll put in the value, the year-to-date value of what that is. If that particular account that you're selecting has a distribution on it, and I think I have actually a utility expense, here we go, and it does have a distribution, then there'll be a check mark in your distribution column. That means it's going to go ahead and distribute it based on that distribution that we assign to that account to your different production details. Again, after you're finished with all of these income statement accounts, your last account will be retained earnings, and click difference to make that balance. You can put in beginning balance again, and that will establish your beginning balances for your income statement. So as you get to the end of your actual fiscal year, these values will be included in that year-to-date information for an accurate picture of your income statement year-to-date. Once we have all of these beginning balances entered, if we go back to our setup accounts and go to the balances tab, we can see how it updated all of our different balances. We're going to expand all groups again, and you'll see now that under accounts receivable we have Red Wing Elevator. It updated that account receivable. If we go down to our purchased livestock inventory, we have a balance for our purchased feeder cattle. If we keep going down to our fixed assets, we have a land that I put in and a building and some harvest equipment. This was the combine. And then down under liabilities, we now have a balance under accounts payable. And with all of that different activity, it's been updating our retained earnings figure to make a balanced balance sheet. So we can go to your reports under financial statements, select a balance sheet, and select your beginning period, and select your company, and preview. And now this balance sheet should agree with the balance sheet that you are using to enter beginning balances for your operation. And when you're done with this company, you would simply repeat the steps for the next company and enter all the beginning balances for each company you have in the database.